Okay, good morning, everyone. Thank you for coming on this brisk morning. Part 2 of the 990 program, looking closer at 990. So we are welcoming people online again. We're supposed to have more people in the room and online, but we want to start on time for those on the webinar. And as a reminder to those online, if you could please print out the slides so you can follow along and make your notes. And if you have any questions, you can call Daisy at 212-714-0699, extension 202. And right now, I'm going to turn it over to Candice Meth, our fantastic presenter from EisnerAmper.
Great, thank you. So as everyone knows, this is part 2 of the 990. I'm going to do just a quick brief review of what we covered in part 1. But in part 1, we went over the core form of the 990. We talked about the general overview of the objectives of the form, and we went through schedules A and B. We used to try to do this session all in one day, but the core form is 12 pages, and then with all the attachments, it seemed like we were rushing to get through it. So we decided it would be a good idea to do the core form in one session and then go through all the attachments in the second session. So today we're going to go through schedules C through R. We're going to talk about some red flags that you would note within the form and some common misperceptions and errors that are commonly made. So just a brief review, the core form starts with the summary page where it tells you basically what the mission of the organization is, and then it gives you a quick snapshot of their financial information. It tells you how many board members, etc. It also includes a checklist of required schedules, and there you're basically going to check off how many attachments you'll be having based on your answers to the questions that they ask in the core form. It asks you whether or not you've complied with other potential IRS filings. So you'll answer yes or no, and then the reader would know that you actually file additional forms. It asks questions about governance, management, and disclosure. And as we discussed last time, the IRS actually has no legal ability to enforce compliance with the governance questions. They're really just asking because they know that it's a public document. And so hopefully you answer those in a positive manner and you have good governance. So I guess you could say it's their way of shaming you into good governance. They ask about compensation of officers, directors, trustees, and key employees, and we went over the definitions of those. You have your statement of revenues, your statement of functional expenses, which typically gets a lot of attention because that's how people do their ratio analysis of how much you charge to program, management in general, and fundraising. The balance sheet, the reconciliation of net assets, financial statements, and reporting. So what I did is I gave you a quick chart of the potential attachments that an organization may have to the core form of the 990. So again, based on their answers to the questions within the core forms, they may or may not be attaching these schedules. And as I mentioned, they tried as best they could in certain instances to make the letters correspond to what it is. So for example, O for other, R for related organizations, H for hospitals, G for gaming. And in some cases, it makes no sense, like E for schools. So, you know, you can't exactly go by that. And they also skip letters. You basically got A through N, A through O, and then they move on to R. So there is no P. So first, last time we discussed briefly Schedule A, which is really the public charity status and public support test. On the first page of Schedule A, you basically identify what type of organization you are. And depending on how you answer this is whether or not you have to fill out the rest of Schedule A. But remember, we discussed last time that being a public charity is a privilege, not a right. So you have to pass this test to prove that you're getting more than 33 1/3% of your donations from the general public, right? So one other thing I just wanted to mention is the pages that follow the test, there's 2 different pages. One of them is if you get most of your revenue from program revenue. So for example, if you're a charity such as this and you run programs and people sign up, and that's really how you generate your revenue, then you'd be filling out one of the forms. The other form is if you've identified yourself as an organization that's going to get most of its revenue from contributions. And so then you would fill out the second form. It's very important to know that you can change your mind in terms of how you're structured. So if you originally filed with the IRS and you said, look, we're going to make most of our revenue off of programs, and that mechanism has now switched to where you're an organization that really starts making most of your revenue off of contributions, you can actually start filling out the other tests, and you don't have to notify the IRS first. The IRS has basically said, fill out whichever test you think applies to you, and you don't have to get our permission to switch that. A lot of people who are reading the form see an organization switch which page they're filling out, and they get concerned, but it's okay. So we discussed in order to do the test, one of the things you're looking for is you're basically looking for people who are the excess contributors. So you're looking at a 5-year average, and you're going to aggregate the contributions over 5 years, and you're going to see who would have given more than 2% after you take that average of the number that you calculate, and see, you aggregate their contributions over the year. So Bob Jones gives $1 million to the organization every single year, then his total is $5 million. I'm going to take the number I calculated, which is 2% of my 5-year average, and I'm going to do $5 million minus my number, and whatever the excess is his excess contribution, right? And then I'm going to add that up for anybody that fell within that category and see what percentage of my total donations that was. And typically what we say is, obviously you should be over 33.33%. If you're not, there's something called facts and circumstances where you can attach something to the form that basically says to the IRS, we had a very unusual year, someone gave us a significant gift, we weren't expecting it, and therefore we flunked, but we don't think we'll flunk going forward. The only time that it would start to really become of concern is if you saw their percentage lower than 10%. When you start to get lower than 10%, then you're going to have a tough time kind of explaining your way out of it. And you know, worst case scenario, as you know, is if you can't meet this test, you default to becoming a private foundation. So then you would start filling out the 990 PF and paying excise tax. We also talked about Schedule B, the schedule of contributors. And again, on this, you're going to list either every gift over $5,000, or if you're an organization that meets the public support test, so you meet that 33.33%, you can do the special rule. And the special rule says that you can give you can calculate and disclose only those that gave 2% or more of your total contributions. And again, the total contributions is on page 9 of the form, that box 1H. That's the number you're going to multiply by 2% to see what their threshold was for picking who they were going to disclose. And we talked about the fact that this schedule, Schedule B, has to be on the same format as the rest of the form. So if you've identified on the first page of the 990 that you report on an accrual basis, your Schedule B is supposed to be on an accrual basis, which means it includes pledges. So it's not necessarily cash that came in the door. It could be pledges as well. If you've identified yourself as somebody who's going to report on a cash basis, then this will be on a cash basis. They have to match. Also on this schedule, it will be stock donations as well as cash donations. And there's a second page to Schedule B where you would note that it was a non-cash donation. And then on the third page, you would explain what type of non-cash it was. And usually you'll see publicly traded securities or whatever it is they gave. In terms of whether or not you have to disclose the names, because that's always a question that we're asked, the IRS has basically said if the organization has knowledge of who gave the gift, they must disclose. Okay. So even though a donor may want to remain anonymous, if the organization knows their name, they're supposed to put their name. They don't have to put their address, but they're supposed to put their name. If a donor wanted to remain anonymous and therefore gave to a donor advised fund, which we see a lot, then the organization can say the money came from the donor advised fund. That's perfectly fine, and that's probably the reason why that person wanted to do that anyway. So putting the donor advised fund name is not a problem. One of the things that also is important to know is if you're looking at a 990 on GuideStar, you won't see the names. And the reason why you won't see the names is the IRS has said that the only schedule that's allowed to be manipulated or redacted when they go to GuideStar is this Schedule B. The IRS has given permission to organizations to basically white out the names of donors for the publicly available 990. But the IRS, you should know, has the names. So the IRS has given the complete form. What goes on GuideStar is a redacted form. Schedule C, political campaign and lobbying activities. So it's very important to know that in general, nonprofits really aren't supposed to engage in a significant level of political activities or lobbying. They can make a special election, which would allow them some leeway to do this. They may be related to a tax organization, and therefore through a sister organization they may be doing some sort of political activity. But in general, they're really not supposed to carry on a significant level of this. And so if they do, they can actually pay a tax on that because they weren't supposed to engage in it. So we've given you the thresholds, and I would say for the most part, you don't see Schedule C filled out all that often. If you do, it's probably because the organization has made that special election that allows them to do some political activities. Schedule D. In the last session, the first thing I mentioned is that you really want to pull out Schedule D when you're trying to compare the audited financial statements to the 990. Schedule D is like a roadmap to how those two documents work together. So the first thing I do when I'm trying to understand how they got to the tax return numbers is I pull out that Schedule D and I put it next to me so I can understand the movements between the financials and the tax return. Schedule D is very important because it also gives you more information about some of the things you might have seen in the core form. So it talks about potential donor advice funds. It mentions if the organization has any conservation easements, maintains any sort of collections of art, historical treasures, or similar. It talks about escrow and custodial arrangements. It talks about the endowment. A lot of people are interested in knowing how an organization's endowment is doing. Schedule D presents actually a 5-year roll forward of the endowment, so you can look at how it's been doing for the last 5 years. The form hasn't been out that long, so for those that are still filling out the 2011 form, they're only showing 4 years worth of information. Next year, you'll get the full 5 years. But what that does is it just basically shows you everything related to endowment. So it shows you the permanently restricted gifts, the income that the endowment has been earning, the amount that the board has deemed to spend out of the endowment, and then the ending value of the endowment. So it gives you a really nice roll forward. That information actually should also be in the financial statements. It's required to be in the financial statements. But a lot of times one of the things that we notice are deficient in financial statements is the endowment information. So if you're not seeing that when you read the financial statements, Schedule D is a great place to go to get that information. And here we go. So you see the roll forward. Again, when the form first came out, it was very unclear what the IRS wanted, if they wanted just the permanently restricted gift or if they wanted the income earned by the endowment. The IRS very kindly gave us a little hint. They wouldn't answer the question, but they gave us a little hint. And they said, down below, we're going to ask you how much of this is board-designated endowment, which is really unrestricted technically, right? Board-designated endowment is when the board takes action to set aside money for the organization, but the next board the next year could decide to undo that. So that's always considered a subset of unrestricted. But they want it in this schedule. So they told you, we want the board-designated, we want the permanent endowment, oh, and we also want temporarily restricted, which usually means the earnings off of the endowment. And they tell you that the percentages you're showing have to get to 100% of line G. So by telling you that little 100% rule, they basically come out and said to you, we want the earnings too. So that was good because that was a clarification that was needed. So you may have seen that in the past this might not have been filled out correctly simply because it was very unclear what the IRS was actually asking. But now this should really model the same table that you would see in the financials, and it shows you how the endowment did during the year. Line D says grants or scholarships, very specific in terms of how they're spending money out of the endowment. They may not be using the money for grants or scholarships, so you might see everything on the other line. And there's nothing wrong with that. It's just that the IRS was so specific in titling that line, and maybe this organization uses their endowment to pay salaries. So that's part of the reason why you may not see anything on line D. Also in Schedule D is where you would see the details of the property, plant, and equipment, which sometimes we call fixed assets. Again, you'll see the cost basis of what they own and the accumulated depreciation and the ending book value. Something that's really interesting is investments, other securities. On the balance sheet in the core form, they broke out the investments where they said investments in publicly traded securities, investments in bonds. Then there's a line that says investments in other, right? And the idea when they put out the new form and it's electronically filed is they didn't want you to create a lot of attachments. They really wanted you to use the form as they created it so you didn't have to create all these manual attachments and scan them into the system. So you actually probably see less details about investments than you used to, because people used to create these long schedules telling you exactly what was in their investments. Well, now they've created a separate line so you're supposed to use them, which is great. But on the investment other line, you tend to see this very large number and you have no idea what's in there. Well, now in Schedule D, if the amount on that line is over a certain percentage of assets, they have to tell you what's in there. So again, very good for kind of solving mysteries. If I see this huge number on the other investment line, I know in Schedule D, I'll get a detail of what that actually is, which is great. Same thing with other liabilities. You know, a lot of times we see this gigantic number on that line and we just don't know what it is. And that's concerning, because what is it that they have to pay out that's so huge? And so this is also another place where you'll find an explanation of other liabilities. And by and large, I would tell you that that number for nonprofits tends to be the post-retirement liability for their pension plan. And, you know, it's almost unfair to the nonprofits because that's, if you will, sort of an accountant number, right? It's a number that they're never really going to pay that out, because that would mean that everyone tomorrow retired and has to get their full benefits. So it's kind of worst case scenario. If everyone retired tomorrow, this is how much we would owe to fund the plan. But knowing that that's really never going to come to be. So that usually goes on other, and then an explanation in Schedule D for that amount. And then the other thing that you'll find in Schedule D is the reconciliation of change in net assets from the 990 to the audited financial statements. And this is what I was talking about when you're trying to compare the two documents. It's really important to, this is what we just talked about. It's very important to have a roadmap to understand why the numbers may not match. And there's several reasons why they may not match. One of those is unrealized gains. So unrealized gains and losses are really just talking about how the fair value of investments change from year to year, but it's not actual cash or revenue to the organization. It's not dollars in or dollars lost. It's merely a depiction of a moment in time as to how that investment did this year. Because of that, within the tax return, it doesn't show up on your statement of revenues and it doesn't show up on your expenses, because it's neither. It's kind of just a description of how the year went. So because of that, that is a reconciling item that you will see in this Part D. There's a specific line that actually says unrealized gains or losses, and you would see the number there. Another thing that you would probably see would be donated facilities and donated services. Again, donated services is nothing in hand. Somebody has given you the free use of space. Somebody has given you pro bono legal. In the GAAP financial statement world, you have to book that, right? So you would do donated services, which is a revenue account, and you'd probably debit legal fees. And so they offset. They have a net effect of 0, but they have to get recorded for GAAP purposes. When you get to the tax return, and knowing that these organizations are rated on this type of stuff, a donated service, because it's actually not a good in hand, doesn't get reflected on your statement of revenue or your statement of expenses, because it was basically something you just got for free, and you can't necessarily sell it or do something with it or exchange it. So this is another place where you would see that reconciliating item. So let's take a look at what it looks like. So here it says, let's start with your total revenue gains and support from the audited financial statements. And then let's start to back out all of the possible reconciling items. And they give them to you, net unrealized gains or losses, the donated services, and then they say other. If you put something on that other line, you do have to define it in Schedule O. So you will see what other would be. And it could be something like a prior period adjustment to maybe our net assets were stated during the year and we realized that something went wrong last year and we need to make a prior period adjustment. You would probably see that on the other line. Okay? And so the idea here is to get down to the revenue that would match the core form, page 9, the statement of revenue. So this is a roadmap from how we got to the audit, from the audited financial statements to the tax return. And we see the exact same thing for the expenses. And again, they show prior adjustments here, donated services that you would back out. One of the things that they're also showing you, another reason why the financial statements may not match, is sometimes in the financial statements things are netted. And one of the most typical things that you will see netted is investment expenses. A lot of times with mutual funds, every time that there's a transaction, there's a little bit of a transaction fee netted in with that, or perhaps it's reported net of the management fee. So the client, when they're picking it up, will report a net number. And usually in the financial statements, somewhere along the lines, it'll tell you that this is net of fees, but it may not tell you what those fees were. So again, because of that, this is another place to basically say, and by the way, on the form, we didn't break out the investment fees because they weren't broken out in the financials either, but here they are. This is the isolated number for investment fees. So just going back for 1 second before we go to Schedule E. Schedule D is a catch-all, right? But by and large, an organization should be filling it out because it represents so many different things that they probably have at least one of, right? They probably have fixed assets, property, plant, and equipment. They probably have an endowment. Maybe they don't, but if they don't, they probably have the fixed assets. The reconciliation process is necessary for any organization. So every organization basically should be attaching Schedule D. This is one of the ones that you should always see. Schedule E for schools. So on the Schedule A, the first page of Schedule A, there was a box that you could check that said, I'm a school, and therefore I don't have to do the public support tax. And then you select it, right? So if you see Schedule A and they check the box, then you should also see Schedule E. And this is basically just kind of a checklist for the schools, and they ask about non-discrimination policies and you know, admittance policies, and it's kind of more of a governance, you know, check the box, do the right thing, how do you make your non-discrimination policy available to the public? And they are supposed to do that somewhere, whether it be on their website, whether they put an ad in the paper, whether they're a member of an organization that promotes their policy for them, but they are supposed to make the policy available. Schedule F. This is F for foreign, right? And this schedule gets a lot of attention. Just in general, the IRS, the Department of Treasury, has been taking a very close look at dollars that leave the United States and why they might leave the United States. And so in doing that, they've created all sorts of additional filings that you may have heard about. But one of the things that gets you out of having to do those filings is filling out this schedule completely and accurately. So, for example, if you are a nonprofit that runs a program in a foreign country, you're going to list the region. You're going to list how many offices you maintain in that region, number of employees. You're going to describe the activity, probably some sort of program-related service. And then you're going to talk about total expenditures in that region. One of the things that's very interesting, I actually had a reporter call me the other day and ask me this question, and I don't know the answer, is that unlike in Schedule I, where you have to list out every single grant that you make and the address it went to, in Schedule F, you don't have to disclose the exact country and address where this is taking place. In Schedule F, the IRS has created predetermined regions, okay? And so you can aggregate everything that you've done in that particular region and disclose it on one line. So, for example, if you have multiple investments in the Cayman Islands, that's part of the Central America slash Caribbean region, right? Which is very vague. I mean, Central America versus the Caribbean, it could be anywhere. And you can put everything on one line. And so there's some sort of intentional vagueness within this schedule. And you know, what I said to the reporter, I honestly, I don't know exactly why they're not asking for the same level of detail. But it's also the software, which sometimes with foreign addresses is not easy to do. But just so you know, you're never going to see a real address. You're always going to see the regions, and the regions' names may sound a little strange, but you're predetermined regions. What goes in here is not only if you're doing a foreign program, but it could be that you sent a grant to a foreign organization, or it could be that you have an investment in a foreign country. So those are typically the three things that you would see. There's also an additional question that will ask you what your grant monitoring process is. So if you're making foreign grants, there's a place to give you the opportunity to explain how you pick these people. You know, do you check the terrorist list before sending money to organizations, make sure that they're not a listed person or a listed organization? You know, what mechanism do you use? How do you follow up on the use of the funds? So there's an opportunity to answer all of those questions. A private foundation, as you probably know, has to do expenditure responsibility or an equivalency determination before making a foreign grant. Public charities are not subject to those strict rules. They don't have to do the same level of due diligence that the private foundation has to do. However, it is recommended, it's still good governance to follow up on the money and to be checking the list before making a grant, because you may be making a grant to a friends of organization not knowing that that organization actually has been linked to some sort of terrorist operation or a country that's been sanctioned or whatever it might be. Okay? So just remember, they're not subject to the same rules as a private foundation, although it's always good governance to follow those procedures. We have a question? So the question is, what would I recommend in terms of that the organization look at all the members of the board and the organization and compare them to the terrorist list, listed persons, listed organizations before making a foreign grant? And what we would basically recommend is first looking for the name of the organization and see if they've been identified. And then I would probably say to look for the executive director's name. I'm not sure that OFAC would list every single board member's name. I don't know that they would have that information. But typically, if they've had concerns over an organization, it's the organization's name that you'll find first. Actually finding individuals is usually a little bit harder unless that individual has actually done something specific that they've tracked. But again, definitely a good step to take. You know, certainly if you were to accidentally give money to an organization that's on that list and somehow that was discovered, the penalties are severe. And really most organizations would have done it by accident. They simply didn't know that they were doing that. And it would be horrible to have a nonprofit pay these significant penalties when they were trying to do something charitable. So the question is, would you check the list for domestic organizations? And usually with domestic organizations, when you're checking the Charities Bureau website, GuideStar, et cetera, and you're following up in terms of their audited financial statements, typically, at least in the United States, if there's concerns over misuse of funds, there's going to be something else that you'll find along with that, like they won't get a clean opinion in the financial statements, or they'll have their exemption revoked by the IRS, or there will be some sort of follow-up with that organization, or there's probably been some negative press about them. So I don't necessarily think you have to be as worried about checking for domestic people on the list, only because if there was concern, that probably would have been made public elsewhere. So additionally in Schedule F, you'd be asked to provide additional information about foreign activities, grants. I mentioned there are 9 regions, but what's important to know is that the thresholds are different, right? So if you have aggregate expenses or revenues from a foreign country of $10,000 or more, then you would disclose that. But if you make a grant of $5,000 or more, then you would disclose that. Same thing if you gave to a foreign individual more than $5,000. So it's important to know that there are different thresholds at play when you're filling out this schedule. In terms of the foreign investment, if the only foreign activity you have is because you have an offshore investment, it would have to be over $100,000 before you would fill this out. So there's all sorts of different numbers that we're looking at and different thresholds for what we reply to. Okay. And again, here's where I mentioned the fact that the foreign investment would have to be over $100,000 before you would disclose. And it's also important to know that the expenses incurred for services provided in the United States. For example, if you were to provide internet medicine and it's really flowing through the U.S., the funds are flowing through the U.S., and then maybe you just mail the medicine overseas. And same thing if you were to fly in the speaker from Spain. So you really bought their ticket in the United States, and they're coming here to give a speech. Those activities would not be shown on Schedule F. They're not necessarily worried about a package going to a foreign country or the fact that we've brought a foreign speaker in. They're really looking for United States dollars spent in that country, okay? And it gets a little bit confusing, certainly, because, you know, maybe you're staying at the Marriott in Kenya, but you made the reservation online, and does that count? And so, you know, you have to obviously make a judgment call, but really it should be dollars spent while in that country. And here I just mentioned again, expenditure responsibility, equivalency determination, the fact that nonprofits are not required to do that, but of course checking the OFAC website is a good idea and a good policy. Schedule G, fundraising or gaming activities. Well, in Schedule G, if you have a nonprofit that holds a special event, you're probably going to see Schedule G. And Schedule G will ask them to break out their 3 largest special events. So you can think of G as gaming, or you can think of G as gala, right? So they'll break out their 3 biggest events, and then all other events will be collapsed into one column. And in that schedule, they're going to tell you what the gross revenues were before expenses. So if I pay $100 to attend your event, on the ticket it specifically says my tax deductible portion is $50. What does that mean? That means that I paid $100. My meal and the value of what I'm getting to enjoy when I go to your event is $50. So the other $50 is considered a pure donation by me to this organization, right? So this schedule will allow you to tell everyone every dollar that came in minus the cost of what they got to enjoy, which would probably be the food, the entertainment, etc., and then the net value of that. And then down below it's going to say, by the way, what did you pay to hold this event? And it will ask you to break out the rental of the facility, the food and beverage, etc. So it gives you a chance to basically show everyone, this is the event that we held, this is how much we grossed, this is how much we net, oh, and by the way, this is how much it costs to hold that event, right? Other things that you'll see on there is gaming. People always ask me whether or not they need to disclose raffles. There are thresholds for disclosing it. You have to have over $15,000 from the activity to actually merit this schedule. So you may know that a particular organization held a raffle and you might not see it on the schedule. You might not see it on the schedule because it didn't involve more than $15,000. Another thing, if you're filling out this schedule, it will ask you how you raise funds, whether you do it through mail solicitations, phone solicitations, in person. So what's very interesting is actually this schedule says a lot about the organization and how they fundraise, but you don't always get that information because they may or may not have to fill this out. So I always kind of enjoy it when they do have to fill this out because I get more information about the organization and how they go about doing their development activities. If you use a professional fundraiser, you have to list the name of the fundraiser and then describe whether or not they had custody of the money or it came in directly to you, how much did they get to retain from the activity, and what did they do for you. Very important to know that sometimes an organization may be using a professional fundraiser and not even realize that they're a professional fundraiser. A lot of organizations will hire someone to do event planning for them, not in any way to contact their donors or do a mailing list or anything like that, literally just to plan a party. But that person has registered in the state of New York as a professional fundraiser. Technically, that person should get listed here, right? And what you would do is when it says activity, you can say event planning. And when it says, do they have custody, you can check the box no. And if you want, you can further describe, this person never contacted our donors, never controlled our cash, etc. They were an event planner who happened to be registered as a professional fundraiser. Okay. That is correct. And so here's where it's talking about the fact that you get to list your events. And again, you're going to show the gross amount of cash that came in for this event. Then you would subtract out the amount that you considered charitable, and you come to the amount that I would have paid for my own meal, right? And again, this should be just things I got to enjoy. So I didn't get to enjoy your postage. I didn't get to enjoy the development person's salary when they put together the event. I enjoyed my meal, I enjoyed my seat, and I probably enjoyed the entertainment if you had entertainment. If you had a goodie bag, I enjoyed the goodie bag as well, right? So these are, in GAAP terms, in financial statement terms, we would call it direct benefit to donor. This is really looking for what the direct benefit to donor was. So on line 3, you're going to come to the direct benefit to donor revenue, right? And then below that, you're going to subtract out all the costs of the things that typically I would have gotten to enjoy, which means that on line 11 where it says net income summary, that should really be 0, right? If you take the entire amount that I paid, you subtract out the charitable portion, what's left should be the value of what I actually got to enjoy based on the cost that you had to pay to provide it. And I know it's not a perfect science. When those cards are printed on the invitation, it says the net charitable portion is $50 and therefore the other $50. I know that that $50 is not actually based on the invoices that an organization is paying. So it's not going to be a perfect one-to-one. But the way that it should lay out here is typically line 11 should really say 0. Okay. Schedule H as in hospitals. So this schedule causes a lot of headaches. When the 990 was originally rolled out, this schedule in particular was mostly grayed out. And so a lot of the questions didn't have to be answered right away. And the IRS has slowly started to ungray sections. So as the years have gone by, more and more parts of Schedule H have started to get filled out. It's certainly a very cumbersome schedule. But of course, if you're giving to a hospital organization, you're going to want to see how they answered these questions. More governance questions included in Schedule H. And so their answers to that will tell you a lot about how the organization is run. Okay. Schedule I, grants and other assistance to organizations and individuals in the United States. So in the old Form 990, if you're an organization that gave away grants, more than a $5,000 grant to any particular individual, you could put the lump sum and say details available upon request. That was great. Can't do that anymore, which means that the 990s went from being about 10, 15, 20 pages to, for some organizations who give a lot of grants, 100 pages, right? So for every amount that you gave away greater than $5,000, remember there's a threshold. They could have given away a lot more grants under $5,000 that you won't see here. But for every single one that you gave away domestically over $5,000, you have to list the name of the organization, their mailing address, their EIN number, how they're structured. Are they 501c3, C4, C6, et cetera? You have to list the amount that you've given them, whether it's cash or non-cash, and then the purpose that you gave it to them for. Okay, so it's a lot of information. It can be a little cumbersome to look at, but this will tell you a lot about who this organization gives funds away to. And also, checking that schedule, you can often see if maybe they've gone a little bit off mission, right? So if they're an organization that's supposed to be giving away money for cancer research, and you start looking at the grant recipients, and it's, you know, MAC Cosmetics or whoever it might be, you know, you can start to see, wait a second, you know, why are big funds going to organizations that I don't think work with cancer? And it might trigger a question for you. So it does give you important details in terms of how they are putting out their funds. Schedule J, compensation. So this schedule gets a lot of press. And I want to go back to, in our other session, we talked about the many phases of compensation. And the reason why I brought that up is compensation within the Form 90 is probably one of the most confusing things there is, because it's reported different ways in different places with different thresholds, right? So let's go back for a second and kind of talk about the different ways that you will see it. In Part 7 of the core form, it asks you to list the compensation of officers, directors, trustees, key employees, and highest paid. It defines highest paid as anyone paid over $100,000. It defines key employees as anyone paid over $150,000. It then very specifically says that has to be based on reportable compensation. So that does not include non-taxable benefits, and it does not include deferred compensation. That was a clarification that came out recently because people were very confused as to whether or not the deferred compensation counted when you were trying to identify who to disclose. The IRS said no. This determination should be based on literally what's in box 1 or box 5 of your W-2 or what's being reported on the 1099. Okay? So we've now identified those people. But by the way, that's always on a calendar year end. Because they want to be able to tie back to a W-2 or a 1099, it has to be based on calendar year compensation. But this may be a June 30 year-end client. So they now kind of have to go backwards and say, well, I'm a June 30, 12 client. I'm filling out the 2011 form. I should be looking at my 2011 compensation information, which if you think about it, by the time this subscribe chart is very outdated. But that's the way this works, right? So, okay, I've now done that. So now I've disclosed the compensation, base compensation, the taxable benefits, the non-taxable benefits, the deferred compensation for my officers, my key employees, my highest directors, right? Then I go to page 10 of the core form, which is my functional expenses, and there's a line that says compensation to officers, directors, key employees, and guess what? It does not match, right? Why doesn't it match? Because that's on a fiscal year end, right? So that's got all my accruals in it. It's on a June 30 year end. It has no relationship to what you just saw in part 7 of the form where I broke out everyone's compensation, right? Okay. Now let's take that a step further. Now I get to Schedule J, which also will show names of people who got high compensation. And it's 1/3 of the names that you just saw on Part 7. And so everyone says, why is that? Well, Part 7, the threshold was $100,000. Schedule J, the threshold is $150,000. And again, reportable comp. So Schedule J, the names listed there will always typically be much shorter than the names that you saw in the core form. And that's because it's only going to pick up everyone over 150. Again, this is one of those schedules where I hope that they paid somebody over 150, because if they did and they have to fill this out, I get all sorts of answers to what they provide to their employees. This asks about housing. It asks about first-class travel. It asks about expense reimbursement policies. It asks about compensation setting policies. So again, you know, my hope is that they do fill this out because it tells me a lot more about how they compensate their employees, what types of perks and benefits they give to their employees, and the mechanisms they have in terms of reimbursement and setting compensation. There is a question within the core form that asks you very similarly, how do you set compensation? So you're going to see that information anyway, but it's asked again in Schedule J. So again, here I can check the boxes. If I'm checking the boxes for things here, probably I'm going to be explaining that later on. I don't want to just check the box, yes, we give housing, and not explain why, right? Because for the most part, housing given to organizations by the IRS is found to be a taxable event, right? There are a couple of exceptions. One of the known exceptions is, for example, if a school has boarders, so kids sleeping at the school, it may be argued that the headmaster has to live on campus in case anything were to happen in the middle of the night, he needs to be present, right? There are a few exceptions to the rules where the IRS has found that it is acceptable to give free housing to particular individuals. But again, you check that box housing, you probably want to explain it later on because it's like sending up a little red flag like, oh, by the way, we're doing this. Let's explain why we're doing it, right? There's technically nothing wrong with flying first class. If that's your policy, that's your policy. Again, it does seem a little extravagant, so if you check that box, you may want to explain. I have a lot of clients who hold their meetings, let's say, in China or Japan or whatever it might be, and so they might check this box and then explain later on that for any domestic flight, it's always coach. But for the rare instances that they do have to fly to China or Japan, for their top executives, they permit first-class travel. Still expensive, but at least it's explaining why they're doing that, right? And again, discretionary spending account, health and social clubs, if you're going to check those, you probably want to explain it. here is where you're going to start to see the officers and directors being disclosed. And what I did actually is I put both Part 7 and Schedule J next to each other, so you can see they're actually not exactly the same. Okay. In Part 7, which is the table you see below, that is the information being reported, but its actual compensation columns are condensed, right? So the only thing you really see in the core form is going to be the reportable comp, your base comp pretty much, coming from a W-2 or 1099. Any comp that you may have gotten paid from a related organization, which may be 0. And then estimated amount of other compensation from the organization and related organizations, if that's applicable. If you make it to Schedule J, if you're one of the ones that got paid over 150 and you've made it all the way to Schedule J, then we're going to show even more details, actually, of what you got paid out. So we're going to show your base comp. We're going to show any bonus or incentive compensation, if you're a commissioned employee, et cetera. Any other sort of reportable comp. We're going to show retirement and other deferred compensation. So again, you have pension plan, contributions were made into that plan. That's not reportable comp. That doesn't go on your W-2. You're not going to pay taxes on that. That's the whole point of the pension. But it will get disclosed here that the organization made a match on your behalf, let's say. So you did get extra compensation. It's just not taxable in the current year. It's going to show up there. Non-taxable benefits. Perhaps you're at a very lovely organization that pays your health care for you, pays your dental for you, pays your eye care for you. These, again, are going to be the things you would see in non-taxable benefits. This is not the amount that's being pulled out of your paycheck, right? That's not what we're talking about here, because that's you paying your own benefits. So this is the amount that somebody's paying on your behalf, okay? And then you're going to total up the columns for the total compensation, right? Column F, compensation reported as deferred in a prior Form 990. This is a very confusing column that was used heavily the first year the form rolled out and really is not used that much since. But I just want to explain it because it's often confused for something that it's not. Column F is basically saying that I need to back up a moment and pull out an amount that you might see on the W-2 that I've already told you about because it was deferred comp, right? So, for example, if you have a qualified 457 plan, right, and contributions are being made into that plan on behalf of the headmaster, let's say, then I reported that amount in deferred comp. Now, 3 years later, that person goes to pull it out of their 457 account, and it's going to show up on their W-2. Well, we don't want to punish them twice, right? So their W-2 in that particular year is going to look gigantic because it's going to be their compensation for the current year, then it's going to be whatever they pulled out of their 457B plan. The column F is the column that basically says, when you're looking at base compensation, please know that included in there is deferred compensation that we told you about 3 years ago, or that we've been telling you about every single year. So don't punish this person unfairly and think that they really make $800,000 a year. Take what's in column B, subtract what's in column F, and that was really their base compensation for the year, okay? The other time that this column was used was the first year that the form was rolled out. You had organizations who had always been reporting compensation on their fiscal year end, right? And now all of a sudden you're telling them they have to switch to calendar year. So that means that they're reporting 6 months worth of compensation that they already reported last year. So it just didn't seem fair, and it kind of seemed like a switch that wouldn't make sense to someone who held the two forms next to each other. So in the first year this form came out, in column F, you would see a reconciliation for the first 6 months, and it was the organization basically telling you, look, we had to switch the basis on which we were reporting comp. You've already seen these 6 months when you looked at our last year return. We're just letting you know, don't get confused. You've already seen that, right? So other than those two instances, usually column F is blank. Okay. Again, when you're looking at Part 7, you're going to see a lot more names listed. Part 7, the threshold is $100,000, whereas up above, Schedule J, the threshold is $150,000. Okay. Other than that, although this tends to get a lot of press and people are very interested in these numbers, Really, it's just a function of who hit the threshold. Organization used to not necessarily understand the definitions of key employee or officer. The IRS has gone to great pains to try to explain who they want listed. So again, key employee is not because you've been tapped on the head and said you're the best, I'm going to make you key employee. Key employee is truly because you met the very specific criteria, one of which is you make over $150,000. If you don't, you just can't be a key employee. But you might be one of our 5 highest paid. The other thing that I mentioned last time, and I just want to reiterate, is you see that column for former, right? You cannot check that column unless the person didn't work a single day during your reporting year. So they really inserted the column former to capture severance payments, right? So they're looking, if you check that box and you disclose an amount, you're basically telling them this person didn't work here at all this entire year. But we have some sort of severance agreement where we're going to continue paying this person for a year, 2 years, whatever it might be. Okay, so that's why that's there. That being said, on every person that works turn report for a year. So if for some reason there was turnover in a CFO position, I may have 2 CFOs on Part 7, right? And so, and I'm not going to check former for either of them because they both worked at some point during my year. So what I might do, just so that people would understand what happened, is next to their name, I might put start date, end date, something to indicate so the reader understands why I had 2 CFOs during the year. Okay, so here again, 5 high paid I mentioned is going to be based on $100,000, and we already discussed the fact that the compensation thresholds are different. And again, we talked about the fact that on the functional expenses, it's never going to match, or very unlikely to match Part 7, because on the functional expenses, it may be on a fiscal year, and Part 7 is always going to be on a calendar year. Schedule K, the bonds. So if an organization has tax-exempt bonds, and they are more than 100,000 outstanding, issued after 2002, they have to fill out this checklist, and they will disclose bonds. They will disclose basically the covenants. They will answer some questions about how they monitor. The question actually is very hard to answer that because most organizations actually don't have that policy because they don't plan to break the bond covenants. So if you check no, you sound horrible, right? Because you sound like, no, we don't, and by the way, we're going to break the bond covenants and we're a bad organization. If you say yes, it sounds like you've already thought ahead about breaking the bond covenants, right? So it's kind of a strange question. So for what I've seen in the marketplace for now is that most people are actually leaving that blank. They don't want to lie and say that they've crafted a policy, but at the same time, they don't want to say no and make it sound like, not only do we have a policy, but we may well break the covenants. So that's a new question that's in the 2011 form, and it's usually actually being left blank. Okay. Schedule M, non-cash contributions. This schedule has become more important these days than ever because, again, in the down economy, people tend to give non-cash goods more often than cash simply because they want to continue giving, but they don't have the resources. It's very important to then understand that in the financial statements, I'm showing revenue, let's say, gifts in kind of $2 million, right? But how did I value those donated goods? Because I've now made my statement of activities look great. I've affected my bottom line by this. But at the same time, you know, how did I get to that valuation for that good? It's supposed to be what the good is worth to the end user. And the end user may not necessarily be the organization, right? So if somebody donates, let's say, pharmaceuticals to an organization that doesn't do anything with medicine, to them it might be valueless, right? But they're going to put it on the books for what that pharmaceutical is worth out in the marketplace. a lot of times an organization is pressured to put on the books for the value that the pharmaceutical company is giving them. But in truth, even though the pharmaceutical company may say, we're giving you drugs and they're worth $100,000, you know, there are books out there that will say, even if to you, it doesn't have much value. Okay? This schedule lets you disclose to the world what you received in its various categories. So there's a line for donated securities. There's a line for donated art, etc. So you can tell the world what you received. You can tell them how many donations you received. You know this works. A lot of times with auction items, donate auction items, to value time, walk onto a show or etc. So how do you value that? And so a lot of organizations will write comparable sales. We didn't know how to value it, but we've seen at other auctions that something like this has gone for this amount. So we pick that up as the best estimate of what it's worth. Right? So again, here is where you would show the number of contributions, the non-cash amount, and then the method as to how you got there. There's lines for boats and planes and cars and all sorts of other vehicles. One of the other things that's on here, again, it's already policy, more so for their own benefit. It allows them to basically say, you know, thank you so much for your donation of this boat, but based on our gift acceptance policy, we can't accept it. And then they're not offending the donor, but in truth, a donation of a boat, although it seems like a luxurious and maybe valuable item, means storing that boat, keeping that boat up until you sell it, and it can cost the organization a lot more to house boats. We've had organizations gifted planes, and it becomes a very expensive process for them because not only do they have to basically house whatever that is, but then they have to involve lawyers and people that can advise them on how they go into the market and sell this type of thing because they're not knowledgeable in those areas. So again, a gift acceptance policy, it shields you. It says, I'm sorry, we can't accept this. Thank you so much. And it also just puts out to the world, what are you willing to take in and how do you value it? You know, especially gifts of stock. You know, tell the world how you're going to value it. Are you going to use the close value of the stock trading date? Are you going to take an average of the high and low? So that way I know if I'm giving you 30 shares of stock, I know typically what you're going to come back and tell me that my gift was worth, as opposed to me thinking that you're going to use the average value and maybe I ended up coming up with a higher value than you did, right? Schedule N, liquidation, termination, dissolution, or significant disposition of assets. There is a box, again, in the core form that basically says whether or not you're going to fill this out. If you check that, then obviously immediately a reader's going to want to go to the schedule and see what's going on. Are you guys going out of business? Are you terminating a particular branch of what you do? Did you give away a huge part of your endowment? Why is this happening? So what's very interesting is there was a lot of debate in the marketplace as to what this meant. Did this include significant unrealized losses? Because obviously a lot of organizations were affected by the market. They were also affected, let's say, if they were invested in Madoff, if they lost a significant amount on the marketplace, should we be answering this? The IRS has basically come back and said, we're not looking for unrealized losses. And they are saying the money's gone. That's a realized loss. That's, your money is not going to come back to you. But unrealized losses, so just a functioning of the marketplace, does not belong on here. The other thing that the IRS just very recently clarified is that this doesn't include significant grants. the organization has chosen to give away its money, that's necessarily on the schedule because that's not liquidation, termination, et cetera. So it's something charitable in nature. They've chosen to give away these funds, and unless they're doing that because they intend to go out of business, in which case they would check this box, that doesn't belong on the schedule either. So for an organization to give away grants, doesn't belong here. Different, by the way, because I just had this experience on the 990 PS, there's a question about substantial termination, construction, et cetera. When they give a significant grant, more than 25% of your net assets does go on that schedule. So there's a little bit of an inconsistency there between how they're defining grants for private foundations versus public charities, but just putting that out there. Related parties. So I often get asked questions about what is a related party. Very important to know that the IRS defines it in very limited terms. Right? So if the organization happens to have one board member in common with another organization, you are not a related party according to the IRS. Okay? The IRS has three very specific types of related parties. You're either a parent-subsidiary relationship, you are a brother-sister relationship, or you are supporting organization relationship. So basically the IRS is saying that there's an element of control, right? So having one board member in common or an employee in common or a spouse in common doesn't give you control over the other organization. Having more than 50% of your board make up the other board is a controlling interest in that. If my board is the only one that's allowed to elect your board, so we completely control every single person that ends up on your board. We control your board, right? If we 100% control you and you are consolidated within our financial statements, clearly we're related, right? So parent-sub relationship is when we make up a majority of the other organization's board. Siblings are same persons on the board. That means 100% of the people that serve on my board also serve on this board. We are brother and sister, basically. It's the same group of people making decisions on both ends. And you also see it's not about partner, or you're seeing more and more disregarded entities. Disregarded entities are LLCs, right, where we, the charity, are the sole member of this LLC. So that LLC is actually going to be consolidated within our financial statements, but legally it's a separate entity. The reason you're seeing more and more of that is for legal reasons. A nonprofit may want to house an activity in a separate legal entity. Heaven forbid something go wrong with that activity. At least legally they're sheltered from litigation. But at the same time, they control that LLC. They're the only ones actually in control of that LLC. So it would show up here. So again, the IRS actually put this table in the instructions. It tells you what type of filer you are. If you answered yes in the core form, then here's where you would put your response within Schedule R. Again, Schedule R for related. Okay. What I've done, if you've noticed, is I skipped over Schedule L, and I did that on purpose. We're going to get there in a second. But Schedule R and Schedule L are often confused for each other, and I wanted to kind of show Schedule R first and then explain why they are different. Okay. So when you're filling out Schedule R, just a couple of things to remember. In parts 1 through 4, you list the different types of related entities. And specifically in part 1, where they ask for the disregarded entities, it says name, address, and EIN, if applicable, of the disregarded entity. And that was very confusing. What do you mean if applicable? Wouldn't they have an EIN or an entity that exists legally? And the answer is that very often, if a disregarded entity was created where we are the sole member as the charity, the EIN of the LLC is the exact same EIN number as the charity, right? So there's no difference in the number. Basically, legally, we're under the same tax filing ID number. There are reasons why the LLC might have its own unique tax ID number. Usually the main reason for that is because they have employees working just for the LLC and they have to file some sort of payroll, and they want that payroll to be under its own unique ID number so it doesn't get confused with the payroll of the charity. So there may be a unique EIN number for this disregarded entity, but there may not be, okay? And here the IRS actually put it in the instructions as to why it might be different. Okay, so in Schedule R, after I've identified who's related to us, right? So I've now listed disregarded entities, I've listed brother and sister relationships, I've listed parent-sub relationships. Now I have to actually go and talk about what type of transactions I had with those entities. And here's a checklist of different types of transactions that we may or may not had. Again, this is 2012 that I'm showing you. The reason why I did that is where it says dividends from related organizations, that's new line. We get really excited about new things on the forum, so yay! But other than that, nothing has really changed in this schedule. So you'll go about checking, maybe you're sharing space, you're sharing employees, there's reimbursements paid, there's transfer of cash, et cetera. You check the box. The boxes have different thresholds, so just make sure when you're checking this box that you know the threshold for answering. If it's not over $25,000, you may not actually have to check the box. So don't go ahead and just start checking away. Just make sure that, there might be a reason why the organization didn't check this. It might have been such an immaterial transaction it didn't meet the criteria. Something that's new in terms of the organization is that for the bottom section, so I just showed you on Part 5 of Schedule R, there's Part 1 and Part 2. On the last page, we're looking at Part 1. This is Part 2. It's right below that checklist. The IRS has come out and clarified that if the transaction took place between two 501c3s, you don't need to keep going and fill out the rest of Part 2. So it used to be I would check the box, then right below it I would say, by the way, this is the name of the organization that the transaction happened with. This is how much it was, and I give details of the transaction, right? Now they're saying if it's between two 501c3s, it's fine. We understand it's probably charitable in nature. You don't have to actually now list every transaction and give us the amount and who it happened with, et cetera. So really, if you think about it, then what they're trying to isolate is when the 501c3 is somehow probably related to a commercial entity and there's money flowing back and forth. If you think about it, that's now they've kind of narrowed it down to that's what they want to see, the actual dollars moving, right? Okay. So that's just a clarification. So again, if you're looking at older 990s, you may have seen a lot of information filled out in Part 2, and the newer 990s that you're looking at, maybe now that part is blank. And most likely it's blank because when you go into the earlier part of Schedule R, you see that the related entity is another 501c3, and therefore they're no longer required to give that information. Typically, organizations feel like less is more, so if they don't have to list every single transaction, they probably aren't going to. Okay. So now let's go back to Schedule L, which Schedule L is transactions with interested persons. The reason why I wanted to go backwards is both of them, if you think about it, are related party transactions in nature. But Schedule R is on the organizational basis. It's two entities being related to each other. Schedule L is literally personal transactions. Now I'm going to identify a particular board member or a particular officer and say that this person had a transaction with the organization, and this is what it was about, and this is how much it was about. Okay. One of the reasons why I saved this for last and why I think it's really important to focus on is there has been a lot of press and a lot of noise about new legislation coming out in New York State regarding related party transactions. The Attorney General feels that related party transactions on their face are not good things, right? Even though we know in the nonprofit world that one of the best things that happens is that you have a board member who works for this amazing advertising firm and can offer you free advertising, or not free, free is always okay, free is great, but can offer you advertising at a very discounted rate, right? So that is actually a good thing. It's not necessarily a bad thing, but for whatever reason there's concern that these related party transactions could get a public charity into some deep water. So because of that, there is a possibility that legislation may be proposed very soon that would say that board members need to take a 2/3 vote before entering into a related party transaction. in order to make that happen, an organization would have to know all the related parties, right? And the truth is that the people sitting in the boardroom may not know every relationship that every other board member has. That's why those filling out of the conflict of interest forms on an annual basis are so important, right? The only way that you know how to answer the questions in Schedule R and the questions in Schedule L is if everyone has accurately and honestly filled out those conflict of interest forms and somebody has collected them and looked at all the relationships and allows them to make informed decisions, allows a board member to recuse themselves from a vote if they know they have a conflict of interest, right? So signing those forms on an annual basis is very important. The core form of the 990 first says, do you have a conflict of interest policy? Most organizations can check yes to that box. The very next question is, do you complete it on an annual basis? Some organizations may be checking no to that. More and more, it's going to be very important that they start checking yes to that question because these types of transactions are going to become more prevalent, right? So, okay, we sign the forms annually. We start to know the relationships, and maybe they get disclosed on Schedule L. Again, we're going to look at Schedule L. There's all sorts of transactions and different thresholds depending on what it is, okay? So, as I mentioned, Schedule R is on an entity level. Schedule L is all about individuals. The thresholds for Schedule L are generally much lower than those used in Schedule R. But again, they vary by section per section. So every transaction that fits the definition must be reported. One of the ones that's pretty low is, for example, if I have an officer who has a family member also working at the organization and receiving any form of compensation, the threshold is only $10,000. So if the executive director's wife is working in the admin's office and she's getting paid $1 over $10,000, it actually is going to get disclosed right here, right? So the threshold is pretty low because those types of transactions, the feeling is they need to be brought to the level of everyone's attention, okay? Again, loans to and from interested persons. A loan to an executive director in the state of New York is very frowned upon, right? So if the executive director has an outstanding balance at the end of the year, that's usually not a good thing. But a loan maybe to the director of finance, technically there's nothing wrong with it. However, it will get disclosed in Schedule L, okay? Also on the balance sheet of the 990, there's specifically a line that says, do you have any receivables outstanding from your officers, your highest paid, your key employees? So it'll get broken out in two places. It'll show up on the balance sheet on its own line, and it'll show up in Schedule L. And one of the things that they ask is, was this approved by the board or a committee? And so the reason why that's such an important question is because people don't realize if you use the corporate credit card for personal use and you forgot to pay back the organization by the end of the year, that's a loan, right? I mean, every time technically that you're using the corporate credit card, you're taking a loan from the organization. And as an auditor, I've been in the field many times and I've heard, you know, my fault, I grabbed the wrong credit card. And I might believe that, and you know, sometimes that happens, but it doesn't happen 35 times during the year. Because at that point, I don't think you're grabbing the wrong credit card, right? And so very important to obviously try to repay the organization as quickly as possible, but even more important, try not to use the corporate credit card for personal use. And so if the answer is going to be yes, the director of finance has a loan, hopefully the box is then checked, and this was done with the approval of the board, right? And that's really easy. If the Attorney General ever came in and wanted to see proof of that, it's probably going to be mentioned in the minutes. And if it's not mentioned in the minutes, there's probably a loan contract. And if neither one of those exists, then he's probably not going to believe you. So again, you know, if you're going to check yes to that, hopefully you have something to substantiate that this was approved of ahead of time. Because the worst thing you can do is have, you know, an executive director come to the board after the fact and say, as you guys all now review the 990, by the way, you're going to see something in there about my loan. Sorry, I didn't get to pay it back. You know, that's not the situation that any organization wants to find themselves in, okay? But this is the reason why if I'm looking for red flags, if I'm looking for things that maybe aren't so kosher that I'm concerned about, Schedule L is a really good place to go, right? maybe it's not a big deal that the board member owns an insurance company and the organization is using that insurance company because they gave the best rate. That's, on the face of it, that's not a bad thing, right? But loans being given to officers of the organization, not being repaid or not being approved by the board, that would start to concern me. Family members, multiple family members working at the organization, maybe not necessarily a bad thing, but a lot of times when you see bad things in the press, it's, you know, nepotism everywhere, right? So those are the types of things that I would want to see and just say, you know, how do I feel about that particular transaction? Should I be concerned, right? And the truth is, there may be transactions going on that are below the threshold and won't even make it to this schedule. And so this is not a schedule that you would see attached to every 990. This is a schedule where you're going to have very specific rare circumstances that it gets attached. So when it is attached, again, it should really catch your eye and it should be something that you're looking at. Here I just gave some of the thresholds on business transactions involving interested persons. This could happen very easily, right? So this is the type of thing where somebody works at an insurance company, an organization got their insurance policy through their company. Do I list that, right? And there's specific rules. Again, it has to exceed $100,000. And it may be a situation where I have to be the owner of the insurance company. I have to somehow personally benefit from that transaction. I have to own more than 35% of the company. So just because I am employed by an organization that the nonprofit is using as a vendor doesn't, on the face of it, make it a listed transaction on Schedule L. There would probably have to be some sort of personal benefit, and that would happen by me owning the company, by me getting some sort of commission when they signed up, etc. Okay. Schedule O, sometimes called Other, sometimes called Oh My God. This is your chance to explain to the world everything that you couldn't explain in any of the other schedules, right? So you can put as much information in here as you want. There are certain things that are required to be in Schedule O. You are required to tell everyone about your conflict of interest policy. You are required to tell everyone about your compensation setting policies. You are required to discuss how the 990 is reviewed before it goes out, right? And that was one of the questions that we talked about in terms of the form says, was the full board given an opportunity to see the draft before it was filed, right? They don't have to vote to approve it, but it's very clear that they don't mean a subset of the board. They're talking about the full board. So if the audit committee vetted the 990 before it went out, the audit committee technically can't act on behalf of the board. So something has to happen where the board has the opportunity to look at it, and that's enough to satisfy the question. But you have to describe in here what you're doing. If you want to say no to that question, you're free to say no, right? The IRS isn't going to do anything about it. And, you know, you can say in Schedule O, no, and here's why. We've decided that our audit committee is going to act on behalf of the board. They vetted the 990, and we're comfortable with that, right? So the reason why Schedule O is so important is because you're just flipping the return, and they say, you know, do you sign your conflict of interest form every year? And you say, nope. Wouldn't you like the opportunity then to explain why you're not doing that, right? And so it's very important to go here and find out why these things are happening. A lot of times what you'll find out is technically when you're answering those governance questions, if the policy was not in place at the time of the year you're reporting on, you're not supposed to check yes to it, right? So especially when these governance questions started first coming out, all these organizations were acting with their lawyers as fast as they could to get these policies in place, but they couldn't check yes yet because the policy hadn't been formally adopted yet. So what you would see is they would check no. Then you could go to Schedule O and it would say, with legal counsel, we have adopted the conflict of interest policy, code of ethics, whatever it might be, but it was enacted 3 days after year end. So that makes me feel much better. Now I actually feel much more comfortable with the organization, but I wouldn't have known that if I hadn't gone to Schedule O. Okay. The notes in Schedule O are supposed to follow the sequence of the 990. That doesn't always happen, but they are supposed to be in order, which will help you during your review. There's actually a question in the core form now that says, did you complete Schedule O? Because when the form first got rolled out, what the IRS was finding is that people just weren't filling it out, even though the instructions very clearly say, answer this question and then go to Schedule O and explain. They would answer the question and there would be no explanation. So now, especially with electronic filing, there's literally a reminder to you because they ask you, did you complete it? And you have to say yes or no. So at the point where you're checking that box, one would think that you'd make sure you go to Schedule O and you'd explain everything. Okay. Another thing that you will see in Schedule O is, remember we talked about other reconciling items to the net assets? You'll find that in Schedule O, and that might be very interesting to know. You know, what else happened to the organization that wasn't part of my revenue that I disclosed, it wasn't part of my expenses, it somehow got buried in other, what is it, right? And maybe it's that prior period adjustment we were talking about, or some sort of correction of an error, whatever it might be. So again, this is a good place to kind of put out to the world what you're about, what your policies are, anything you want them to know. Also, back in Schedule O, simply because there's no room for it in the first part, remember we talked about the list of the compensation of officers, key employees, directors, et cetera, and there was a box for compensation from related organizations. If for some reason they are splitting their time between two organizations, it's also good to know, well, how many hours do they spend at that organization? Does the compensation make sense? You know, you're earning $100,000 here, the presumption is you're working 40 hours here. How many hours are you spending at the other place? So actually in the back in Schedule O, you'll see those same names. If you said yes, they work for the related, and you'll see the hours that they're spending at the related organization so that you can compare. What we did here is we just decided to give you a standard type of answer that we may see. Again, I'm not saying that this is a good governance answer or a bad governance answer. This is just typically the types of responses that we would see. Here, for the process of reviewing the Form 990, we state that the organization is using its audit committee to review, that they've been given this responsibility by the full board, and that the audit firm goes through it with them. Again, so what we're basically saying here is we're basically acknowledging the fact that the full board does not look at the 990 before it's filed, but instead this is what we've opted to do, and we think it's reasonable. Okay. And here, this is just going back to, here are the questions where it says, for example, 1A, if the governing body delegated broad authority to an executive committee, explain it in Schedule O. So it's literally telling you to go there. Question number 9, is there any officer or key employee who can't be reached at this mailing address? If yes, go to Schedule O. So it will delegate when you have to go to that part. Again, 11B, here's where it specifically says that you have to describe the process in terms of the 990 going to all members of the governing body. In terms of the written conflict of interest policy, B, it says we're officers, directors, or trustees required to disclose annually. And then, does the organization regularly and consistently monitor and enforce compliance? Described in Schedule O. In terms of the compensation, again, 15B, where it says if you said yes to either 15A or 15B in terms of the process for determining reasonable compensation, go ahead and describe that in Schedule O. So these are the things that at a bare minimum you should be seeing in Schedule O. So some red flags. Some of the things that we see, for example, reporting of grants, Part 3, Line 4A, statement of functional expenses are often different, Schedule F and Schedule I. So here, 4A, when you're reporting the amounts that are included in your major program expenses, see where it says code? Right now, code is actually not required. The IRS still hasn't taken it out of the form, but they keep delaying the enforcement of making you use code. So you might see a code, you may not see a code. There's a list of codes that you can use. So, I mean, the number is there if somebody wants to use it. But typically, unless the IRS forces you to do something, nobody really does it, right? The only time that you're required to use a code within this form right now is on page 9, if you have an activity that's in the UBIT column, unrelated business income tax. If you have something in that column, you have to use a code to describe the activity, Okay, that's the only time it's required. Then expenses, including grants of, this often gets very confused. So what I'm saying is this is one of my major programs. I spent this much, including grants of this amount that I gave away, right? People often confuse that and they think that means grants that came into the organization, right? But if you notice where the parentheses are, they're saying expenses including grants that you gave away. It's all in one parenthesis. So they're talking about expenses. They're not talking about revenue coming in. But that often gets confused. Another thing that people fill out differently is the statement of functional expenses. And a couple of things that are important to know because they're new changes that are out there is, for example, remember we were talking about that post-retirement benefit calculation? Well, it's been getting larger and larger in terms of the liability. And nonprofits feel punished by that because they may have to book, let's say, a $400,000 adjustment because the actuary changed the discount rate that they were using in the calculation, knowing, though, that they're never really going to pay out that amount. So it kind of unfairly punishes them, and yet typically it had shown up on page 10 of the functional expenses, usually, let's say, in the management and general column. So it threw off their allocations and made them look like they had way more expenses than they did. The IRS has now come out and basically said, you can take that adjustment, the actuarial piece of the post-retirement benefit, as in the non-amount that you're going to pay out, so everything not actual cash, and you can put that in other reconciling items to the net assets. So they've come out and said it doesn't have to be on page 10. We realize that's not an actual outlay of cash. So that can be one of the things that you'll now put in Schedule D as an other reconciling item. Another one that they've now come out, and again, this is going to be 2012 form going forward, they've now come out and said you can also put in other reconciling items is bad debt expense. Bad debt expense, another thing that haunts nonprofits. Somebody makes a pledge to them, they think it's collectible, all of a sudden that person disappears and they can't make good on the pledge. Not fair to the nonprofit, not an actual outlay of cash, a foregone opportunity, if you will, right? So that bad debt expense almost always appeared in the management general column, and in a given year, if there was a significant pledge that somebody canceled, it could be very large. So again, they've now said that that can move over to other reconciling items. So hopefully what you're getting now is a little bit more consistency in terms of what your functional expense schedule shows. And so therefore, when those watchdog agencies are giving their ratings, and they're giving you the rating based on what's in programmatic, management in general, and fundraising, it's fair playing field for everyone, right? Everyone's putting the same things in that schedule and removing the same things out of that schedule. Schedule F and Schedule I, a lot of organizations in the past didn't realize that they're supposed to be listing their foreign investments. And what happened is the Department of Treasury came out and said, we've got these other forms, the FBAR form, the FATCA form, all sorts of really scary forms. But guess what? If you're a nonprofit and you go ahead and you list these investments on Schedule F, you don't have to file those forms. So people were like, oh, I didn't know I was supposed to be doing that, but I would much rather do that than fill out the scary FBAR form or the scary FATCA form. So because of that, now you'll start to see more organizations putting their investments in Schedule F that are offshore in the Cayman Islands or wherever they might be. But simply before that, they didn't know they were supposed to be doing that. So, you know, again, hopefully now Schedule F will be more comparable. Schedule I, in terms of listing the grant information, again, a lot of times that schedule is very incomplete. It's missing addresses. It's putting in zip codes that you know can't possibly exist, like 000, it's not a zip code. Or it's putting in an EIN number that's not right. So hopefully now, again, with electronic filing, it will reject you if you don't have the complete information. So now as more organizations move towards electronic filing, hopefully, again, there's more consistency there. Again, just including the amounts for Schedule G and showing the direct benefit to donor. Sometimes it isn't done right, but it's now more well known that you really should be coming down to a 0 on line 11. So now organizations are figuring out that, oh, in order to get to 0, here's what I have to do. Compensation. Again, hopefully organizations are being very honest when they complete this and really listing what benefits they give out, knowing that they have the chance to explain later on, yes, we give out this benefit and here's why. Failure of the public support test, we talked about this. Again, there may be facts and circumstances as to why one fails, and they will attach something to explain that. Typically, as long as you're over 10%, it's not a huge problem, but an organization that goes under 10% is probably going to have an issue. Concentration of donors. Again, if you fail the public support test, it's probably because you have one donor that's your main donor. Maybe that person is part of a related organization. But again, you want to take a look at where the money's coming from in terms of the categories. And then if that person is listed on Schedule B year after year, then they're probably your concentrated donor. As somebody who's pulling a 990 off of GuideStar, you may not see that person's name. So in order to find out if there's a concentration, then I would go to Schedule A and just see if they're over 33 1/3%. If they're not, that means there's some sort of concentration with a particular donor. In terms of just a quick wrap-up of key points, remember there are plenty of relationships in this community between board members, spouses, other organizations. It's just important to know those relationships so that you can make sure that Schedule L and Schedule R are accurately reflecting it. In order to do that, an organization should be signing their conflict of interest policy on an annual basis. Remember that compensation is being reported on many different thresholds on different periods, and so trying to compare it from each part of the form may not be possible. And then the other thing that I just want to point out in terms of best practices is that when giving money to foreign organizations, although public charities are not subject to the same requirements as a private foundation, best practices would indicate that they just double check before they send money overseas. That's it. Questions? Yes?
$50,000 on a gala, and then you look and see that what they actually netted from that was $1.
Well, no, I mean, one of the ratios that we've provided is taking a look at the cost of your special events. Usually, actually, what people are doing now is they would take their total contributions for the year and divide it by their total fundraising expenses for the year. So not just the gala per se, but they're probably looking at their development costs in general, everything that they would have allocated to fundraising, and just basically see, are we getting the biggest bang for our buck, right? And if that ratio comes out poor, then taking a look at identifying where the cost is eating up the profits. One of the things that we talked about in one of the earlier sessions is golf outings, right? Golf outings are extremely expensive and may not be netting enough proceeds to make it worth it. So then are you holding a golf outing because everyone really enjoys that day, or are you holding a golf outing because it's actually a strong fundraiser for you? So just taking a look at the costs that you have, and again, I'm isolating those costs to the rental of the facility, the food costs, and maybe the professional fundraiser that you've hired, as opposed to the ancillary costs like the postage and the whatnot. But taking a look at those primary costs against the actual contributions that came in for that event, and seeing what the ratio is and whether or not that was really worth it. Any other questions? Thanks.